Brent, I'm glad we have a chance to talk today. We are talking about recession-proof investing, 4 tips for navigating market volatility. We've been hearing a lot of scary headlines about the market lately. What's going on?
Yeah, to sum it up in one phrase is tariff concerns.
Yeah.
So current administration is talking about putting tariffs on things, specifically China, Mexico, and Canada as well. And what's happening is that's causing a lot of issues to run through the pipeline. So tariffs are inflationary in nature. At least that's the argument against them. And so what that has done is caused all the red you are seeing here.
Mm-hmm.
So what's interesting to point out here is, a lot of it is the big tech companies. So these companies normally drive the market up really high, and then when things pull back, they're the ones who get beat up the worst.
Mm-hmm. Yeah, good point. But a lot of those other little stocks seem to still be in the green, so that's good.
Absolutely.
So I want to talk through some strategies then when it comes to market volatility. A lot of people assume that cash is king. Are you recommending people allocate a larger portion of their portfolio to cash right now?
So if somebody's holding cash or a cash equivalent, normally it's in the form of a treasury fund or something like that. We've already got that built into the plan. So I think the question you're looking at is, should people be moving to cash? And in my opinion, the answer is no. Because if a portfolio is designed well, if there's a cash need, if they're taking regular distributions or they're getting ready for a big one-time purchase, the cash is already there. And so having the structure correct from the get-go allows you to not have to worry about, should I be stockpiling cash? Should I be doing this or that? You're built ready for that volatility.
And how about defensive stocks, things like healthcare and utilities? I mean, we all still get sick. We still need to eat. What do you think about that?
Yeah, so tech gets all the press, okay? Because what they do is they run up really high and everybody loves the gains. And then when the market gets spooked, they pull back very far. So kind of like that chart we looked back on the other screen, tech makes up a big weight of the market, but there are a ton of other things to invest in. And this breaks them out nicely: healthcare, energy, consumer staples, and utilities. People still have to spend money on this stuff no matter what's going on in the stock market. And so there are places to still look for gains. Now, once again, a portfolio that's weighted correctly, you already have positions in these, and they're going to boost you up while the tech is pulling back.
And how about dividend stocks and other fixed income investments like bonds?
Yeah, so dividend stocks are great because many of those, they continue to pay dividends even if the market gets, volatile and a little bit rocky. And then bonds, our position on bonds, we're not really for those in the current environment, but there are fixed income, structured notes, other things like that are a little bit less volatile. We don't like to use the word safe because they are not safe. They can still pull back, but it is going to be less volatile and it's not going to move like the big tech stocks do.
Right. And then last, even during downturns, or especially during downturns, keep investing. This is known as dollar cost averaging.
Yes, it's a wonderful thing. And no matter what happens, I always get some email that says, hey, the market's pulling back. Should I quit investing? And the answer is absolutely not. So dollar cost average is simply consistently investing in the market. And so when it's going up, you continue to buy in. More importantly, when it pulls back, you continue to buy in. And so, yes, the market's falling, but you're getting a better deal on those positions. And so the market always recovers. And when it does, you are going to recover quicker because you have a lower cost point. So it's very important to stick with the plan and let the plan dictate your decisions and not make decisions just because, oh my gosh, I checked my account and I'm freaking out today.
Right. You're taking the words out of my mouth because it does come back to what you say all the time, which is when you have a financial plan, you are not reacting emotionally to these scary headlines.
Right. And so we're just the sounding, person for our clients. And so if they call concerned, that's completely normal. Who wouldn't be concerned to see things, start to take the turn for the wrong? And so essentially we tell them, keep calm. We've built the plan for this.
Right.
We don't try to time the market. We're not going to tell you to pull out and then we'll let you know when to get back in. It's not timing the market. It's time in the market. And then I often remind people, one of the biggest events was 9/11. Market pulled back considerably, fully recovered in 42 days. So who were your losers? The people who did the panic selling. So you want to make sure to stay invested and then just wait for the recovery to come back.
Right. Well said. Brent, well, if somebody wants to talk through whether they are either positioned correctly or they want to talk to you about building that financial plan that accounts for this kind of volatility, what's the best way to reach you?
Yeah, with the volatility, it's a good time to do it. 614-430-8383 or young-wm.com. We'll get you on the calendar. We'd love to talk about it.
Great. Brent, thank you.
Thank you.